Thanks for coming, everyone. We are meeting this week to go over the same example deal that we looked over last week, which is Alamo Estates in San Antonio. It's a 208 unit deal. It is a 506C, meaning that it is open to share with the public, but it is open to accredited investors only. So the operators gave us permission to use this as a sample deal for this education course. It is actually accepting investments. If you'd like to participate after we go through this, you are free to do that as a limited partner. So the way that the club works is we'll find deals like this from experienced operators, and then we will pool our capital and negotiate for better terms. Usually that's a little bit of the general partnership so that we can be more involved in the day-to-day management and protect the investment. We may also be able to negotiate for higher returns. And then once we're part of the general partnership, we can go and raise a little bit more capital from our own networks of limited partners that we either have a relationship with or on a deal like this, other accredited investors. This is a pretty typical spreadsheet. They're all a little bit different. So sometimes the more you're familiar with them, the easier it is to look at one that's new, but you'll always have to do some familiarization when you open it up, even if you're experienced at this, just because things are always in a slightly different place. They're designed a little bit differently, but you will start to see the same ones over and over again because you have several organizations or people who create these types of spreadsheets, and they'll either provide them to their mentorship students or you can purchase them online. And so once you start seeing the same ones over and over again, they're a lot easier to find your way around. What we're doing today is if you like what you see in the pitch deck, the returns are in line with what you're looking for, you've looked at the photos, the property, the business plan, and you've vetted out the team, and you think that this is possibly a deal that you would like to invest in, the next thing that you would need to do is go through a second layer of due diligence. So due diligence, we do it in layers. We'll do the initial one where we're just believing whatever the operator tells us. We're just taking everything at face value. And we may do things like look it up on a map or whatnot, but we're not going to do any outside research because we're just going to take on that first layer to believe what they tell us. And then as we go through due diligence, we're going to get more and more research each layer down we go. Going through the spreadsheet, again, we're going to just believe everything that they tell us in the spreadsheet. Then we would say, okay, this looks reasonable, but then you might want to go and research some of these line items individually. And so we'll show you how to do some outside research. That would be a third layer. And let's say you're a syndicator and you would like to purchase this property. Maybe this is a pro forma that a broker sent you. It's going to look very similar. They may not send it in a spreadsheet format. They may send it in just a profit and loss where you have all your revenue, all your expenses, and then it'll give you a net operating income. And then you can plug those numbers that the broker gives you into a spreadsheet if you're building an original spreadsheet. But if you decide you want to buy it and you go into more layers of due diligence, that's when you start doing more and more research. So that would be when you would visit the property in person. Once you get it under contract, would recommend you definitely would want an inspector to do a physical inspection, be inside every apartment, look at all the major systems like foundations, roofs, plumbing, electrical. So as we're going deeper down, you're going to be doing some physical due diligence, but you're also going to be working with your financial due diligence. So you're going to need to prove all of these out with first line research, talking to the tax assessor's office, talking to getting your quotes from your insurance agent. You would also be getting bank statements and getting their company tax returns. You're going to get a copy of all the leases. So as you go through this, each layer is going to become more and more substantiated by documents and paperwork. So we're still at the very beginning stages of doing this deal. It's already been through the due diligence by the operators because we're not the ones buying it. But you can go all the way down to the point of buying it. But instead, what we're going to do is we're just going to ask the operators to show us their due diligence that they've already done. So by the time the club is seeing these deals, usually they're already under contract, they've already been inspected, and they're already through due diligence, and they're getting closer to closing. So we just have to make sure that the team that we're working with is capable and has done appropriate due diligence by asking them questions and getting some documents from them. So we'll go through what that might look like on here. Looks like we have a question in the chat.
Jeff had a question. What's the best way to find the cap rates for a specific location?
This is a tough one because it's something that's usually behind the paywall of a database like CoStar. You need a broker to help you access those, or you need to be paying a pretty hefty monthly fee to access those databases, usually several $1,000s a month. So when you're looking for cap rates, the best way to find those is to go through your broker and they can look those up. You will start to see a lot of repeats of cap rates because you're going to have cities of a similar type and a similar size, and they're going to have similar cap rates. So you might look at something in Phoenix and compare that to something in Dallas or something in Austin. But if you're going to look in a different market, like a smaller town in Alabama, the cap rate might be a little bit higher. So the more close to a downtown it is, and the newer the property is, the lower the cap rate is going to be. You'll start to see that over and over again. So I assume for most of what we're looking at in the previous market before interest rates went up, that our cap rates are going to be somewhere around 4.5% to 6.5%, depending on the condition of the property and how far out of the downtown area that it is. But the broker really is the best way to get access to that information. It can be difficult to find.
I have a follow-up. Is the cap rate for something this big going to be different than a single family residence when you're trying to figure out the cap rate for that?
1 to 4 units are evaluated on what's called a comparables basis. So you're going to look at what the other house sold for in order to get the value of your house, duplex, 3 or 4 family. But on a commercial property, which is going to be anything residential 5 units or above, or anything else. The only thing that's residential is 1 to 4 units. And that's just whatever the neighbor sold for that's similar to yours is what yours is going to sell for. When you're doing a commercial property, you're going to take the business income into account, and that's a cost basis. And so it's going to be a little bit different on the appraisal, just because you need to be comparing it to similar properties the same way you would with a residential. But at the same time, you're going to be comparing it to similar properties who might have different incomes, and that's going to affect the valuation. So it's based on both comps and business income.
Thanks. Good question, Jeff.
Let's dive right into this one. Usually this first page is pretty self-explanatory unless you don't know what each of these line items means. So we'll go through these. Some of them are pretty obvious and we'll just blow through them. So purchase price is $21 million. The pricing guidance, that's also called the whisper price. It's basically what they think it's going to sell for, what you should be offering for it in order to have an offer accepted. And that can go up or down depending on the interest that the property is getting in the market. So sometimes the whisper price will be lower, sometimes it will be higher, but it's nice that they have that in their spreadsheet because it tells you, seeing a list price for this, but this is what you have to offer to be competitive. And you're coming in at say 20 million, you know that it might not even be worth writing an offer for, or you're going to write your offer for 20 million and hope it gets accepted. In yesterday's market, it probably wouldn't. In today's market, as we're seeing interest rates change in a volatile way, we're going to start to see more things going for under the list price and certainly under the whisper price. Physical vacancy only refers to the apartments that are physically empty. We have other types of vacancy called economic vacancy. That would be any reason that somebody is not paying you the full amount of rent. If it's under market value, that's lost to lease. If you have given them concessions, like we'll give you a free TV or 2 months free if you move in, that's another type of economic vacancy. You also have people who just aren't paying their rent and they move out and they may never pay it off, which is charged off as bad debt. You might sell that to a collections agency and hope you can get 10 cents on the dollar. And then sometimes people will include a renovation loss here, meaning that the apartment is going to be vacant a little longer than it normally would be because your turnover is not just a quick clean. You have to do a full renovation. So you may have a renovation vacancy loss listed here as well. We're going to go through the revenue line items first. So the gross potential rent is what you could be making if everybody in that apartment complex was paying the full amount of market rent on time and you had 0 vacant units. So this is the most the property could possibly make in rents. Now you're going to add on to that something called RUBS, which is, it should be residential utility bill back system. If you don't have separate meters on each of the units, then what you're going to do is either charge them a flat fee for utilities, or you may have something in your property management software that will calculate their utility usage based on how many bedrooms and how many occupants versus the other ones. So say a 2-bedroom is going to take up more energy than a 1-bedroom, and it will give everybody a very exact percentage of what their responsibility is to pay. And then you'll split that up. Now, RUBS has become more and more common, especially in larger towns. It used to be several years ago that some landlords were just paying all the utilities and they weren't billing any of it back. But as RUBS has become more common, large property management companies will start to charge for this, and they'll drive the trend across the entire market. You're seeing RUBS a lot more often, but rather than looking at this and thinking, well, that's all that we're going to get for it, you might say, well, maybe they're charging too little. Maybe they're not charging back common area utilities, things for like public lights and all that. You can bill all that back to the residents. So there might be some wiggle room in here, even though you might see that the previous owner is charging RUBS. Maybe they think that they can charge more. I like how they have what the breakdown is per month here, because sometimes when you have 208 units and you see $305,000, it doesn't really give you any concept of what that means per unit. But when you come over here and you're going to see that the unit count is going to be factored into it in this formula up here, it shows you that that's a reasonable amount. Other income is everything else. Sometimes they'll have it listed as a line item, and you may see that on the more detailed pro forma. This is laundry income, pet income, late fees, application fees, basically anything else that anybody is writing you a check for. And some properties have some unique other income. If they have a billboard that they're renting out, they may have some things that are not related to the rental operations. So that would be a non-operating revenue. So you have operating income, operating expenses, and then you have non-operating income and non-operating expenses. So you need to be able to keep those straight, especially on the expenses. Some non-operating expenses would be things like your mortgage, and that's going to be different for everybody. So we usually leave non-operating expenses out of these pro formas because that's really going to be custom to each owner. Any questions on the revenue?
Yeah, the header right there, trailing. What does the trailing mean, Emma?
Great question. This is what the current owner is operating it at, a trailing 12-month, or you may see a T3 or a T9, especially if you're halfway into the year. They might have just given you from the beginning of 2022, which would be a T6. So these are the numbers that the owner gave. Stabilized is what the new owner is projecting they're going to be able to operate this at. So what I will do here is just go through and see if these increases are reasonable. So their other income is actually going down, but their rent is going up quite a bit because they're taking this on renovated units, and this is going to be on unrenovated units. So you're going to be looking at the delta between these. So their loss to lease is going to go down quite a bit because a large loss to lease shows that there are a lot of units in there that are not being charged market rent. And that's one of the first things that you're going to do as a new operator is come in and you're going to raise rents on the people who are not up to market rate unless they're on some sort of a lease. But as soon as their lease is expired, you're going to raise their rents and they'll either renew at the higher rate or they'll move out. Vacancy loss, you can see here it's 7.8%. They're projecting 5%. It could be a matter of making sure that you are marketing it properly. And the bad debt is going to be cut in half because, again, this is a management thing. You're going to make sure you're knocking on people's doors. You're making sure that you're sending it to collections. It's just making sure that the managers are doing a better job of collecting what they're actually owed. All right, let's move on to the operating expenses. Now, this is where you really need to have a good eye, and this is where experience is really going to pay off. When I was learning how to do this, I would hear people say things like, oh, I was going through the expenses and I saw that these utilities were really, really high. And I thought, oh, well, I can lower that, or this is out of control. This is a red flag. And then I would look at these things and I would say, oh, I don't see anything out of the ordinary because I didn't know what I was doing. I didn't know what I was looking at. And so recognizing fees or expenses that are too high is definitely a matter of experience as you get more familiar with properties and you get more familiar with how they're being run. If you're the type of person who really loves spreadsheets and you want to buy a property, learning how to do this is very, very important, and you don't have the benefit of experience. So that's where you would bring a partner in and run these over and say, what do these expenses look like? Or you're going to have to research every single one of these line items one by one, which can be pretty tedious, but it gets faster. Obviously, the better you get at it, you know the sources to look at, and you'll start to see things jumping out that are way too high or way too low that you can catch quickly. But that's definitely an acquired skill. There's one thing to notice when you're having large commercial multifamily, that your payroll comes out of your pocket. That's why the management fees are so much lower. One reason why they are. So you may have a management fee that's something around maybe 3 to 5% of the gross income, whereas a small multifamily or a small commercial even will have up to 10%, because they're going to be paying all of their payroll. If you have a single family house, you're not going to have a maintenance man all to yourself. You're going to have to share that with everybody who's being managed by that management company. So their fees tend to be higher of the gross. Whereas in a multifamily property, it's much lower. You'll see 3% or 5%, but remember that you're paying your own payroll. Payroll is for anybody that works on the property, like the leasing agent, the assistant leasing agent. You're going to have the maintenance person, the assistant maintenance person, and that's not going to include contract services. So somebody that doesn't work for you, like the pool maintenance or the landscaper, that's going to be contract services, and that's going to be an additional line item. Looks like we have a question.
Yeah, Marcus asked, is it common to factor in some slight increase in vacancy, even if it's temporary, with the rent increase?
We typically do that in year one. I don't like to see the revenue go up a lot in year one just because those vacancies are longer. And even if people are excited to move into your new place and you fill those up very quickly after marketing them, getting them to the marketing point takes longer. So yes, we do have year one vacancy is typically going to be higher. I've seen it as high as 25 to 35%. I would feel very uncomfortable if year one was less than 15, certainly less than 10 is a big red flag that they either don't know what they're doing. Usually by the time we see them in the club, they're being handled by experienced operators. So when I see that as more people who are new and they're maybe raising money for their very first deal. And if you're working with a new operator, and you need to be the more experienced one versus when you're working with a very experienced operator that has managed lots of these properties before and they've been able to reach their return targets on sales, you're going to trust them a little bit more. So Rogelio says a cell tower could be other income. Yes, if you've got a tall enough building, you can rent out the top space to a cell tower. That's something that you'll see a lot of times in new development, especially in urban areas. All right, so Rogelio also says, what is the difference between loss to lease and concession? Loss to lease just means it's going for under market value. And a concession is giving them free stuff to get them to move in, or maybe they're upset. So you're going to give them a free month's rent because you're trying to have some sort of customer service. So it's either incentives, just anything you give them for free to incentivize them to move in or to stay or to not be mad. We'll go next to repairs and maintenance. And you'll see here again that it's per unit. And you'll need to learn what these norms are across the industry, but it also can be very market specific. And again, this is just going to be something that you learn by experience. The way that you do that is by an opportunity comparison. You're going to be wanting to look at pro formas from similar deals in a similar area. The more you look at, the more you're going to start to see patterns, especially if you have an area that you look at a lot, which is called your farm. So if you're only looking for a certain number of units in a Dallas suburb, and you're only looking at those types of deals, you'll start to be able to see these patterns really quickly. Don't feel like you need to do it on your first pass through. But a per unit really does help you see if that's reasonable. Repairs and maintenance for a smaller complex, we can see 250 to 300. The bigger the complex, the less that repair and maintenance is going to cost, because you're going to have a full-time maintenance guy, maybe even an assistant maintenance guy, and you have so many units that are very much the same, that they're going to be using the same parts. They're going to be having the same problems over and over again, and those maintenance guys will get faster and faster at fixing it. So the bigger the complex, the lower this will be per unit. 139, this is one that I would want to verify and just see what they're doing, because right now they're doing it at 121, so they have raised it, but I might like to see a little bit more padding in there. But this is not one of the things that's a deal killer. You just have to go through all of these, and if you have significant deviations where maybe their total is $7,300 a unit per year, and I'm coming up with the higher end of that, it's going to be $12,000 a unit per year. That's the thing about the larger the complex, the more units you have, these little micro changes add up over 200 units. But the opposite does too. If their revenue is off by a little bit, maybe it's higher or lower, it can be multiplied across the entire complex, and it can either be greatly to your benefit or greatly to your detriment, because one little change is magnified so much that it's really important on these larger complexes that these assumptions be pretty tight because small changes have a big impact. Repairs and maintenance is anything that is something that needs to be ongoing. It does not include capital expenditures. That would be deferred maintenance. Those are things that the owner should have been taking care of, but they weren't. And so when you take it over, you're going to have to do a catch up, and that's your capital expenditures, your CapEx, your renovations. That's typically not included in an expense line item. Other than right here, you've got some replacement reserves. And these are the cash reserves that you put aside for capital expenditures. This is for when a roof goes out or for when water heaters go out, things that don't need to be done on every turn. They're not really a repairs and maintenance category. So this is where the expense is. When you actually spend that money, that would be something we would call below the line, meaning it is a non-operating expense because you've already accounted for it here in your expenses. If you do it again, you're basically double counting that expense, and that can really throw numbers off. And I do see things from owners where they have their capital expenditures and their replacement reserves both in the expenses line. And that's really nice because they might think the property is more expensive to operate than it really is. And you take that out and you move the CapEx to below the line, and suddenly this income starts to look a lot better of a profit margin. Now, usually in these larger complexes, you're not going to see those kinds of mistakes. That would be something you're looking for more with a mom and pop operation. All right, repairs and maintenance depends on the age and condition of the property. How is that projected or estimated? Any specific tools? Yes, the older the building, the higher that's going to be because even the faucets are starting to go out. You have to replace them. Whereas you have a brand new building, it's going to be a lot different. So I'll give you a little tip here. When you're looking at this number here, this 50%, this is a percent of the estimated gross income. Your expenses are going to be roughly 50% of your estimated gross income. Now in Texas, sometimes that can go higher to 55 or 58 because Texas tends to have extremely high property taxes and extremely high insurance because of tornadoes and floods and things. And so 50% is showing me that they're going to be running a pretty tight ship on a Texas property. I might like to see that a little higher, like 55. Now, the current owner is running it at 57, which means that the new owners are projecting that they can beat that because they're going to increase their income. But you can see that they're also planning on increasing their expenses. So it's mostly a raise in income that's going to give that difference from the 50% to the 57%. So if you see that it's much below 50%, they better have a new building. If it's a really old building, you would want to see it higher. Now, this building is in fairly good condition. It doesn't have any major plumbing or electrical or foundation or roof issues to fix. So they might be able to rent it and run it for this 50% expense ratio. I think that would be fairly efficient. The larger the building, the larger the property, the more units in the property, the more efficiently they can run it. So that 50% is not unreasonable. It's usually a rule of thumb.
Emma,
Yes.
say the life of a commercial roof and other things like that, do you find that they last as long or longer than like single family stuff? Can you
No.
give a comparison?
No, I think the roofs that you put on a commercial building, if it's a garden style apartment, they're going to be the same materials you'd be putting on a residential one. It's just covering more square feet. And then the second thing that you need to look at is if it is a flat roof, because flat roofs tend to be more expensive to install. And their lifespan can be really dependent on how well it was installed. Because that's why they're more expensive, because they take more skill to put in there. So if it's a flat roof, you're going to want to have a different type of replacement reserves budget. And that's the same for anything major. For example, if it has cast iron sewer pipes and copper freshwater lines, you can expect a lot of floods because those copper freshwaters will pinhole. They have a lot of turbulence. Once they're 30, 40 years old, you'll start to have a lot of problems with them. They'll be flooding out units. So a lot of that is going to need to be replaced with some sort of a PEX. And then the cast iron sewer pipes are going to flood because they leak, because they rust. And so you're going to have to replace a lot of the cast iron pipes with PVC, or at least the joints. Maybe the runs can be left as cast iron, but there's going to be a lot of the boots that you need to replace. And so that's one of those things when you're looking at the renovation budget, you're going to see that they've accounted for that. What we're looking at right here in the operating expenses really doesn't account for any of that other than this replacement reserves, but this is going to be everything that's done after the renovation. So where repairs and maintenance factors in the age and condition of the building, you still have to look at the renovation because maybe they are planning on doing some of those upgrades, that infrastructure upgrade, and the repairs and maintenance can be pretty much the same because you've repaired and replaced a lot of those things during the renovations. So yes, this does depend on the age of the building, but it also depends on how well and how extensive the renovations are, because you may be basically creating a newer building, or you may not be, depending on how much money and time you put into it.
All right, thank you.
All right, turnover. This is how much it's going to cost you to renovate apartments that people move out of that are a quick turn. You need to replace carpet. You need to do a full paint or paint and patch. This is not a renovated unit. It's just a unit that somebody moves out. You get it cleaned and touched up and you move somebody else right in. And so they're doing $144 per unit because they're only going to expect maybe 10 to 25% of the units will turn over each year. So you're not going to have to do this on every unit every year. That's why it's so low per unit, but they're planning on spending $30,000 a year just on turnovers. Utilities, these are the public areas. And a lot of these larger buildings will have a lot of common areas, or you call it CAMs, common area maintenance, is like the laundry room, the fitness center, the leasing office, the exterior lights in the hallways or the security lights, the electricity for the sprinkler system, the parking lot lights. So you're going to have common area utilities. You may be able to build some of these back to the residents in the RUBs. I would have to see if they're planning on doing that. But because they are planning on running these utilities more efficiently, that tells me a couple of things I might want to find out. When I see an expense go down, I definitely want to know why. This could be that they're going to charge more of these utilities back to the residents and by increasing the RUBs, which they are. Or it could be that they're planning on putting in some more energy efficient fixtures like LED lighting, low flow fixtures in the common area, restrooms, sprinklers. They may be fixing leaks. So there's a reason that they think that they can lower those utilities. You just might want to find out what that assumption is that says that they're going to run it for less. Administrative is all your stuff, your printers, the papers, the computers, everything that you need to run stuff, the envelopes, the stamps, the flyers. When you're doing some sort of notice that you have to put on somebody, you have to pay somebody to walk over there and do it, which would be payroll, but the actual paper and all of that and the ink and everything comes out of administrative budget. So that seems to be pretty much in line with what they're already doing. So again, we're looking for deltas here. I like the expenses that go up because if the expense is higher, it's going to eat into our returns. And if the returns are still high enough that I'm happy with it, that is fine. It's when I see them lower that I start to wonder, what are they doing and what are they changing? So far, the only thing I see that's lower is utilities, which can be easily explained by low flow and efficiencies. So marketing would be ads on Zillow, $10 a week. Apartments.com can be kind of expensive. They're going to get banners and flags and things that they're going to put around the apartment. They're going to have things that they hang up at the local library or fire station or police station. Come rent here. So all of the marketing that they're going to do, they're planning on spending about $39,000 a year, which seems like a pretty healthy budget. On a really small complex, you might see that even zero because they're only going to do free things, right? But occasionally you might have to market something. So I never like to see zero here unless it's a very small building and they're not planning on doing any paid advertising. But you need to have that option open to you because if things are not renting up and you haven't made a nice fat marketing budget, then it's going to cause you lots of problems down the road. So you need to make sure that this is healthy looking. So they don't have any other expenses. Again, this would be like other income. This would be anything that wouldn't be covered in these line items. And sometimes you'll see that labeled as miscellaneous. Insurance here, it's $105,000 a year. They're planning on it going up to $120,000. This is something that I always like to double check. I want to see the insurance policy. I want to make sure that they have proper coverage for floods and tornadoes. And I want to make sure that this number is based on an actual quote or a binder from an agent rather than a guess. So the fact that this increases is good, but it's not increasing by enough that I feel 100% comfortable with it. If they were saying it was going to be 150, and especially if they had an exact number here, like 152, 246, that's probably based on a quote, but 120 seems more like an assumption. So I'm just going to want to do a little bit of extra research there. Ask the operators where they got that number from. Is the insurance based on a quote or a binder, or have you gotten a quote yet? Insurance is one of the last things to get taken care of before you close, but they can get a quote pretty early on. Sometimes look at the binder and it's way higher than what was quoted, especially in these expensive states like Texas that have a lot of natural disasters. All right, we've got a question. With the context of payroll, administrative marketing, where do you put the expense for third-party property management? That is a good question. That is the next line item right here. So this management fee here is what the current property is doing and what they're going to do. So you could do some quick math here. If you take this $91,000 that they're paying in a management fee and you divide that by the effective gross income, you're going to get 3%. That is pretty typical with a large building. Like I said, this is 208 units, and that's going to be normal. You can see 5, 6, 7% for smaller buildings, like a 60 unit, 80 unit, even 100 unit. But when you get up to these bigger ones, 3% is pretty typical. So I'm glad to see that. And that's probably what they've already negotiated with their property manager. I do like to see the property manager agreement just to make sure that these are based on some sort of information. But again, that would be the next layer of research that you'd be doing. Now we're going to go through, like I said, property taxes is going to be going up. Is that enough up that I feel like that was gotten from the assessor's office or directly from some sort of an official source, or is this an estimate? Is the estimate coming from a property manager, which it often does? Has that property manager reached out to the assessor's office? Where is that coming from? Because really what's going to knock you down are these insurance and property taxes. Those are things that are out of your control. And they're usually, as you can see here, one of the largest line items on here. So utilities and payroll, property taxes and insurance are by far the biggest expenses. And you need to make sure that those big line items are accurate. Replacement reserves, we already went over that. That's what you pull aside per unit to replace big stuff. And this is a $200 per unit. Like I said, you might see $250 or $300, the same as for the repairs and maintenance on smaller buildings. And the bigger they get, the cheaper it gets to run because everything's the same. And you might be getting bulk buys on water heaters or something. Franchise taxes, Texas does have a franchise tax that it charges you. I'm not really sure why they're not having to pay this, but you will see that on some properties and you won't see it on others. So you'll have some line items here that are unique to the property, and that's one of them. Again, we've got the percent of the estimated gross income is 50%. That's pretty reasonable. It seems more on the optimistic side, but like I said, the bigger the property, the more likely you are to run it for a cheaper percentage of gross profit. What we have here is the net operating income. You take the effective gross income, you subtract your total expenses, and what's left over is your profit. Now, the reason they call it net operating income instead of net profit is because there are things you have to take out of this after you get the operating income. That includes your mortgage or anything that is not related to operations. I'll give you an example. We're doing a refinance on one of our properties and we are paying for loan extension fees. We are paying for an appraisal. There are all sorts of things that we need to pay for that wouldn't be considered an operating expense, but it is coming out of our personal bottom line. So you want to compare apples to apples, which means you want to compare operating expenses, things like loans or legal disputes that you're having to handle within, say, the partners are arguing and you have to pay a mediator or a lawyer. That's not going to be a property expense. That's more of an expense that goes to the business. So non-operating expenses would be business expenses not related to operations. So you're going to see the cap rate here, or the year 3 yield on cost, is going to be 6.9%. So they're buying it at just below a 5 and they're going to raise it to just below a 7. And a 5% to 7% split or spread on your cap rate, that's pretty normal. What I want to see is what they're going to operate it at versus what they bought it at. It needs to go up. Now that's different than what we talked about last week with an exit cap rate. That's the cap rate that the new buyer, when you sell it, is going to pay for it. So I'd like to see the new buyer be paying a 5 or a 5.5 because the economy can go down and these prices could drop. But this is your internal operating cap rate, and the buyer is only going to see that when you give them your expenses. We have a raised hand. Go for it, Marcus.
Hey, yeah, just so on what you just said, I want to make sure I understand. You're saying the cap rate, 5 to 7% growth from the operators that you guys are investing with, but it's sort of going back down. Are you still looking for it to be higher than the original cap rate, or does that matter?
The purchase price that the new buyer, so our sale price, should be a higher cap rate than what we bought it at. So our entry cap is this 4.78 is our entry cap. We want the entry cap of the new buyer to be higher than 4.78. And we actually want it to be lower in real life, meaning that we sold it for a lower cap rate than we bought it. That would be great, right? And it would be great profit, and we would like that. But as a sign of conservative underwriting, you want that entry cap for the new buyer to be higher than what you paid for it, because the market could change, like what we're seeing right now, and the prices will start to go down. So that needs to be baked in. The operation cap, or the internal cap, or whatever you want to call it, is what you're actually operating it at. So you're going to take something that you paid this much for, and you're going to operate it more efficiently. So you're effectively raising the cap rate.
All right, makes sense. Thank you.
All right, let's pop back over here. This is the debt service coverage ratio. This is considered to be operating below what their debt payment is. You need a 1x. So let's say your mortgage payment is $20,000 a month, but your net operating income is only $20,000 a month. So you're able to cover your mortgage and basically nothing else. That would be a 1x. Now, if you are making a little bit extra above and beyond that, it'd be like a 1.2 or 1.25, meaning that you're making some profit on top of your mortgage. And in single family house, it could be considered like if you pay your mortgage and all your expenses, that's going to be roughly, maybe you're cash flowing $200 a month per unit. That's not very much because you have expenses and you have a mortgage on top of that. So that 1.25 is basically saying that it's going to cash flow a little bit above the mortgage. The fact that this is a 1x, there's a story behind that, because most lenders won't loan to you unless it's at least a 1.2 or 1.25. So I don't know what's going on there. And this is definitely something that I would want to ask about, if that's either an error or a misunderstanding, or the lender, because usually that means it's break even. So that might have a backstory there, and that would definitely be something that I would want to research. For underwriting, what spread should be used between entry cap and exit cap? Everybody's got a different rule of thumb on this, and it really is market dependent. I would say something like 0.5% per year of ownership would be reasonable. But again, that's going to be more of a rule of thumb that you would just start out with. You would actually have to get some data to support that. We're going to switch over now to the acquisition assumptions. So the acquisition fee is 2%, which is pretty normal. That's basically what you pay to the sponsorship team for their time in procuring this deal. It is very, very stressful to raise money, to secure a loan, to put in a lot of earnest money, to pay due diligence costs, to fly out there, spend time. It takes a long time. It's expensive and it's stressful. So usually the team will try to recover either the costs that they have into it, like earnest money, or pay them for some of their time in acquiring this asset. So that's pretty normal. I wouldn't like to see it much higher than that, but if it's lower, you wonder, like, how are these people getting paid? If you can't figure out how they're getting paid, then they're not going to be that motivated to run it, because they're not getting paid that well. Transfer tax and closing costs, these are all things that the title company is charging. Transfer tax is a government fee. Closing costs, 3.5%. Again, you might want to see if that's from a title company or where they got that number from, but that's pretty normal in the industry. Cash reserves are usually working capital, and you may have an interest reserve or a lender's reserve, which is cash that the lender is requiring that they are going to hold on your behalf, and they will release it to you when you hit certain benchmarks, meaning that they're going to let you pay your interest-only loan. They're going to collect interest up front for a certain period of time, and they will pay themselves out of what they collected up front. So you might have to pay any payments for a little while because you paid those at closing, which means you have to raise that cash up front. So senior debt, you're not assuming a loan. That means you're taking over someone else's loan. If you're buying it here, they have an 85% LTC or LTV. but you are assuming the loan, it might be 65% or 75%, which means you need to raise a lot more cash. And it's also kind of a pain to take a loan over. So assumptions typically are going to be less returns because you have to raise a lot more cash. Interest rate 6%. Again, I don't know if this is an assumption or if this is something they got off of a term sheet. At this point, they should have a term sheet, but you might ask to see the term sheet. IO means interest only period for 4 years. That's pretty good. I've seen 3 years, sometimes 1. It depends on the kind of loan you're getting. If the occupancy is less than 90%, you're typically going to get a bridge debt, which is like hard money lending in commercial world, meaning it's a distressed property and you're going to pay a higher interest rate and they're going to have interest only for less time. And they're expecting you to get this thing renovated and stabilized up to 90% in a short period of time so that you can refinance into your permanent debt. If it's not distressed, you can get a permanent loan on it, but you can still raise money to renovate it. The thing is, most bridge debts will have renovation money included in it that you can pull in construction draws, but permanent debt typically does not. So if they're getting a permanent debt because the occupancy is above 90 and it's not distressed, then you're going to need to raise the renovation money in cash. And typically the returns will go down the less money you borrow, but it's also less risky. So the rate cap cost or the strike is a 2.4% because it's going to be an adjustable rate. So it shouldn't be able to go any farther than that above what they're existing paying on their adjustable rate mortgage. All right. Vena, you have a question?
Yeah, Emma, I have a question on why are we calculating only for 36 months term? What is the significance of that? Why not more?
On 36 months. Oh, the term, sorry. Most commercial loans have very short terms. You're going to have something that's usually called a 3-1-1, which is a 3 years with 2 1-year extensions. And to get those extensions, you're going to want to know what those terms are, which is going to be on the term sheet that they got. So if they want to renew that, they're going to have to pay an extension fee. And they are also going to have to meet certain requirements, like their debt service coverage ratio has to be a certain amount, 1.25 or something like that, or they're not going to qualify for their extension. So you want to know when you're researching this, what type of loan they have, what the term is. 3 years is pretty normal. And then 2 1-year extensions of 3-1-1. And I'm seeing a lot of those right now. It's interest only for 4 years, which means that their first extension would still be only interest only. And then they might have to start paying principal on the second extension. Again, I'm only making that assumption based on what I'm seeing here without having a term sheet in front of me. But the loan is really what's going to make or break a deal, because the cost of your money, whether it's private equity, meaning having to give them a huge chunk of what you have, 70-30 or 80-20 split. If you can get cheaper equity, they're going to take a lower preferred return, or they're going to take a 50-50 split. Obviously, that's going to change the returns to the general partners and to the limited partners dramatically. If you can get a really cheap loan with a low interest rate, obviously that's going to be better returns. The more the interest rate, the more expensive the money gets, it really affects the returns heavily. Like I would say the purchase price and the loan terms are going to be the biggest levers that are going to change the returns. So having the purchase price and these lending information dialed in, as well as those large expenses like total rent, for the revenue side, and the 3 to 4 large expenses, those have to be nailed down, because if they're not, it can have a major impact on the returns. And something you're looking at that's an 18% IRR suddenly starts to look a lot worse if they miss any of these. The other issue is you need to make sure that they don't need to refinance or sell this with a gun against their heads, because if they have to do that during a bad market, meaning rates are sky high or the prices are low because there's some sort of recession, and they are backed into a corner where they have to sell or refinance in an unfavorable environment, then they might not be able to. They might not be able to get out from under the loan if they're upside down. And then that's when they default and they lose the entire property, and the limited partner's investment is gone. Like that's how you lose your entire investment, is to default on a loan. It's usually not just one thing that causes somebody to default or have to sell at a loss. It's usually a couple of different things, like interest rates went up, and they're doing road construction on your road for 1.5 years and nobody can get in or out, so you're not renting. And one of the operators got a nasty divorce and can't pay attention to it. So usually it's a couple of things that will combine to really take a deal from a good deal to really suffering, which is why you want this financing to be really dialed in and be very forgiving on the timelines. They're not doing a refinance which is good in the fact that they're not basing their returns on a refinance somewhere down the line with terms that are right now are impossible to predict. When we were in a very low interest rate and stable environment, we could predict these refinances with some degree of certainty, but over the last 2 to 3 years, when we know that the bottom's going to fall out of this, we just don't know when or why, then it made these assumptions really difficult to guess because interest rates could have gone negative or they could go shoot up like they have. We just didn't know. And there were sometimes we were being asked to make the choice between a loan with a different cap. We were choosing between 2 products and we were really having to guess which direction interest rates were going to go. Because if they went up, this loan was better. And if they went down, this loan was better. And it was getting impossible to make those predictions on refinances. So I like to see them when there's no refinance. Really the downside of that is that you don't get your chunk of cash back. Because if they refinance it in year 2, you get a 65% back. You can go invest that in something else. Whereas this, you really do need to plan on having your money tied up for the entire 3 to 5 year lifespan of the hold. You just need to make sure if there is a refinance plan that these assumptions are reasonable given our uncertain, volatile lending environment right now. There are so many tabs here that you can go through, but what you're going to want to be familiar with is the profit and loss statement, which is the income and the expenses. And those are the most important in addition to understanding that financing tab. They'll give you a summary right here. I really like this tab because you can see it all at a glance. How much you're borrowing, price per unit, the project IRR, the unlevered IRR. That basically means the IRR if there was no debt on the project, but since there is debt, you're going to have a better return. These types of things are what I would be looking up on Investopedia.com if I didn't understand what these things meant. You don't have to understand every single one of these to feel comfortable investing in a deal or purchasing a deal, but the more of them you know, the better off you're going to be. And if you don't know all of them and you aren't comfortable and this isn't your specialty, make sure somebody on the team understands all of these. That's the nice thing about the club is because we have an underwriting committee and we go over all of these things together. The project IRR is 25%, but the limited partner is 18.6 because the general partners are going to take part of that. So that's the difference between your LP returns and your total returns. So make sure if you're investing as an LP that you're looking at the right column. But because in the club, we invest for a piece of the GP, it's really nice that they've disclosed it here. Normally I've seen a lot where you don't see what the GPs are making, but this allows us to calculate our percentage of the GP that we've negotiated and figure out how that's going to boost our returns on our cash, because this is a return basically on our time spent operating the thing alongside the main sponsors. So again, the acquisition fee, asset management fee, the IRR hurdle means that once they get past 70%, they're going to get a 25% return to the general partners. Since we do negotiate for general partner returns, we do get to share in that promote, but sometimes we would negotiate where we wouldn't share in that promote. Every deal is going to be different. If you're a limited partner, I like to see the hurdle closer to what they're actually showing us we're going to do. I'd like to see that a lot higher, 18%. If it's lower, like 7%, and they can still advertise an 18% return, which is pretty good, then, great. I'm glad they're getting a good promote, even if I was just a limited partner, because I want them to get paid. I want them to care about this property and keep an eye on it. So I don't necessarily reject something that has a low hurdle like this. I just want to make sure if they've got a low hurdle that I'm still making a good amount of money. If I saw a low hurdle like that, and this was like a 14 or a 15% IRR, I'd be like, come on, guys. You need to share a little bit more with your money partners. And I do see that scarily often. Here's your sample investment. This is one of the most important things because this is what, if you're raising capital, all of your limited partners are going to ask you, how much am I going to get paid and when am I going to get paid? So this tells you that your year one cash flow, not that great, right? Because it's vacant. Most of them, they're doing tons of renovation and they're spending lots of money. So the year one cash flow is typically pretty low. I would say this is lower than normal. I would usually am going to see something between 3 and 5% on year one. And since there's a 7% preferred return, that's going to be accruing because you can see that they're never going to hit that 7% preferred return the entire life of this investment. So what they're going to do is they're going to tack that on to the end. And so that's where this hurdle comes from. If they can get us over that preferred return, they're going to get a promote, but they're not going to see that till the sale either. Because if we're not even making our preferred return during the hold period, they're not making any GP distributions either. So, or we wouldn't be if we were club partnering with them. So it's one of those things where this is going to be a deal that you look at as more of an upside deal where most of your money is going to be made at the end. And you can see if you put in $100,000, you're basically getting $38,000 as distributions over the 4 years, and then $155,000 that you refi and sale. And so most of it's coming at the back end. The sources and uses, this was something that we looked at on the pitch deck last week, and you just want to make sure that it's even. Wow, those closing costs. These big properties, it kills me to see how much being paid out in closing costs, but these deals are tough to close, take a lot of time and a lot of work. Usually you're paying points to your lender, like 1 or 2 origination points to your lender, your broker. You got to pay broker fees. You got to pay the title insurance. It adds up really fast. This is a lot of the professional fees that the buyer's agents and the seller's agents will split. So that's why that's so high. So the CapEx and reserves, that's the $4.3 million. That is their renovation budget plus some reserves that they're putting aside for working capital. So you're going to go through those renovation tab here, and you're going to check there's an error here. So that would be one of those things where I'd have to go and backwards trace this. Or in my case, I would just ask the operator if this is my error or their error and get myself a clean copy. So in this case, their total planned renovation cost is $3.4 million, but if you go over to the summary, it's 4.3. So the rest of that is their reserves. The general renovations here, this is all the stuff that's not included in the interior, $500,000. So swimming pool, termite inspection, landscaping, trim repairs, all of this kind of stuff that's mostly exterior or common areas. You want to see that there. And then they're spending $2.5 million on the unit renovations. So we can take that and quickly calculate that divided by the unit count, which in this case is 208 units. And we're getting $12,000 per unit, which that's a pretty healthy budget. I'd like to see 7 to say on the low end to 12 to make sure that they can put in their granite countertops and all that. So 12,000 there, that's pretty good. Another $500,000 for all of this, pretty good. Again, I would take a closer look at this. If I still like the numbers here, I might want to dig into this a little more deeply. Like they're doing black appliances, but if they were doing stainless steel, I would want to make sure that they budgeted enough when they're doing the high-end kind of stuff. The comparables here, you don't normally see this on a spreadsheet pro forma. It depends on who's you're using. And this is just going to compare the other properties that are nearby, like Stone Chase, Aria, Meridia, Montecito, and they're going to tell you how similar they are, what they're renting for. And we saw this in the pitch deck. And so this is the source of that. So we're not going to look over that too closely here because we did talk about it last week. But what you would want to do for research here are a couple of things. You want to go to apartments.com and you want to look up if there are any buildings that they didn't include here that you feel like they should have included here. And you're going to want to see what the similar units are going for in these units, if it agrees on apartments.com, rent per square foot, rent per unit, and just to see if you believe that it's reasonable what they're asking to rent this one for. So the subject property, that's what it's going for the 1 bedroom, 1 bathroom. That's the current. And you just want to, so it's below everything else. So that shows me that there is room in there, but I would just want to verify those comps. Another way to do it is if you're going to call those complexes up and ask what they're renting those for, what the square feet are, go to that property website, because when they get this big, they usually have their own website. And if you're local, you can actually go secret shop, which is maybe the best way to do comps. But obviously, we're not going to go to that level if we're just putting, 50 grand into a deal like this. You don't want to have to research it as hard as you would if you were buying it, because the team is more important. You want to make sure they've researched it and they know what they're doing. That way we don't have to do every nitty gritty piece of research like this. So you're going to look down and just make sure that this is in line with what's already being charged, and there's some room to raise that up. I like to see comps based on renovated units. This looks like it's existing. I like to compare to what are these other renovated units going for. So that might be a layer of research that I would do just to see where it is, if we fixed it up, and comparing it to one that's already fixed up. Same as when you're flipping a house. Sales comps, again, this is going to give you your cap rate. So you can kind of see the price per unit is the one that's most commonly used. So we're buying at 101. The average is 137. So that means you're getting it under market. Let's see anything else here. That one's kind of close to it. So I'd probably take a close look at that one. And then the highest one I would see, is that really a comp? Because sometimes you'll see with the highest one, it's like, might be way nicer, have way more units. It might not actually be a comp. So I like to just take the high and low, the outliers, and see how it compares to what I'm doing. But I know that this price per door is pretty good for that area just because of my background, but you might have to look it up. This is very hard to find. This is where a broker comes in very handy. And the last thing I want to look at here, pro forma, again, is just like a summary tab. It's really helpful, especially if you're doing the spreadsheet yourself and you're having some weird data come out of it. Come check your pro forma and make sure that all of these are correct. Because if you're seeing wacky numbers or there's nothing in there, there are zeros, it means you may have done something incorrectly. And so pro forma is what I use to do error checking. Sensitivities are, we're going to change some assumptions. We're going to say, what if we could only sell it for a 6 cap? But what if we could sell it for a 5 1/4 cap? And this is going to tell you that target IRR based on what they're doing. But you can come into this table and see, okay, this is the best case scenario. If we sell it for a great price and rents go up really fast, we could make this much money. But worst case scenario, that's terrible. But they all look like that, right? It's better than what you're getting in a lot of other investments. And so worst case scenario, other than default, where you lose everything, you're looking at somewhere in this range. And so you're going to try and keep it somewhere in this area, what you might expect. So when they're saying it's an 18.6, you have to understand that there's a range there. So that sensitivity, you can kind of play around with those things and see if you change rent growth, you change expense ratio. And this is a way that you can play with the what ifs and see best and worst case scenario. Let's say we have rents go down the first year because maybe there's a recession. You could play with all that in here and just get a sense of how good or how bad could this actually be. See if you feel comfortable within that wide range of possibilities. And then the last thing here is this is where you enter in your assumptions to see what your returns, your waterfall is going to be. So this is the reason I like the summary tab, because this tab you're going to go through and it's going to give you a lot of detail about what all of these financial ratios are meaning. But the summary tab over here is going to break those and put them into a single chart that you can refer to pretty quickly. And then I love that they have these links over here, because this is how you do your research. I would open up all of those links and just go poke around those websites and see what you find and see if you can corroborate these assumptions. Now, don't feel overwhelmed. You don't need to know how to do all of this on your first deal. The team is more important, but if you refuse to learn how to at least read these types of things, you may be in the wrong business. At the core of what we're doing, it is a finance and accounting business, and real estate just happens to be our product. If this is something you feel uncomfortable with, but you are resigned to the fact that you would at least need to learn how to feel comfortable with it to the point where you can read it, you can use it as a decision maker, that's fine. But if you are saying, this is terrible, I never want to learn how to do it, I'm just going to hire someone else to do that for me, that's very risky. You need to at least be able to read these. And like I said, it's an acquired skill. Compare similar deals, similar pro formas, and just get used to what looks normal and what looks abnormal. Like I pointed out a couple of the red flags that I'm seeing, not necessarily deal breakers, but things that I'm going to want to find out. What is your underlying source of data to show me that this number is reasonable? There are just a few questions that I would want to ask on this particular one just to get some clarification. Do we have any questions? Shiva, go ahead. What's your question?
So how do I know if this syndication deal is structured for 10331 exchange? Maybe this is, yeah.
That is oftentimes in the pitch deck, because people who are doing a 1031 exchange are definitely going to be going in under different terms than your average limited partner. Because if you want to do a 1031 exchange, maybe this is getting into a little bit of the legal side, you have to exchange into the same entity that you came out of. So if you owned a property in My Property LLC, then My Property LLC has to go into the next one. What they do is they form a tenants in common or a TIC agreement, and then your LLC is basically joint venturing with their LLC. It's very similar to what we're doing with the club, or what they'll do with people who are, their main job is investor relations and capital raising, they will joint venture with that LLC. And so you will just have to talk to the operators to see what they're doing for a 1031, how much the minimum is, because the legal paperwork on that sometimes takes longer. So yes, the 1031s are there. You may need to share some of the cost of the legal work or amortize that over, or it may be new legal work that you need to do for your own TIC. So it can get very expensive very fast creating these 1031 TICs. But like I said, that's something that you're going to see in the offering memorandum. You're going to talk to the operators about, and then you're going to verify when you're reading through the legal documents that things are working the way that you're expecting. And you might want to have your 1031 exchange custodian check over those documents to make sure that it's being structured properly. It's important to know a lot of syndications won't take 1031. So it's just a deal by deal type of thing.
Got it. Thank you.
Kevin, did you have a question?
No, I was just going to encourage the people. Thanks for coming tonight. I know we're all newbies at this. I encourage you join the meetings on Mondays. You'll hear a higher level conversation. You'll hear a lot of the terms that Emma's gone over used fluidly through the trained professionals, but at least you will have an understanding a little bit of what when they blast through these things. I'm about maybe 10 meetings ahead of you guys if you've never joined one of them. It can be done. I'm still drinking from a fire hose. It's gotten a little better, but it's still horrible in some instances. But this is a good learning group, so it's okay. It's a safe space to ask a silly question. There are no silly questions, so just remember that. So if this is not your cup of tea, don't give up on it yet. Just keep plugging away at it.
Now we all need to give our virtual high fives to Shiva and Kevin, because even though you're drinking from a fire hose and you may not be feeling terribly comfortable, what did y'all do this week?
We both invested in our first commercial property. So that was pretty exciting.
Yep.
So as joint venture partners, not just limited partners. So I think we had a little high five party in our Slack channel. That's an amazing accomplishment when you think about it. You've only been in it for what, 3 months?
Maybe 2-3 months at the most. Yeah.
So it is possible. We definitely have lowered the barrier of entry to be able to get into these types of deals. You don't have to understand every little bit of this. Even something I would spend hours going through this, but I will tell you some of the biggest hedge funds or private equity placement firms, they don't go through it at this fine-tooth comb level. They make sure that the big rocks are taken care of, and they do spend a lot of time vetting the team to make sure that the team knows what they're doing. So they spend more time vetting the team than they do vetting these numbers. They just want to make sure that the basics are there and the assumptions are reasonable, and they'll spot check. Maybe they have a list of like 10 things that they'll spot check. Of course, every firm is going to be different. Some of them do more, some of them do less. I don't want you to feel like you need to understand everything on here before you go into a deal. I would say that if the team is a good team and an experienced team, and you vetted them out and they have a good track record, and these things look reasonable, and you're going to do some research on some of the things that jump out at you, and you're going to do it with the club, because what we'll do in the club is we'll take something like this and we'll assign people in the underwriting committee to look these things up. Like, this guy's going to go check the taxes, this guy's going to go check the insurance, and this guy's going to go check the rental comps, and this guy's going to go check the sales comps. And so we will split those tasks among ourselves and then come back together in the club meeting and compare notes. That's the advantage of investing through a club. You can't trust everything, and you still need to make your own decisions, but at least you can spread out the work of research among people that you trust who can do a good job doing it. And you don't have to be terribly experienced to be able to go and get some research. As long as you have the right sources to look at, and you bring it back and you run it by, and everybody is invited to go and look at those resources as well. I just don't want you to be completely overwhelmed by these, but you do need to feel comfortable reading through them and picking out a few items that you would want to do further research on. Does anybody have any questions on that?
There was one last question. The Excel spreadsheet for this one, was this provided by the operator?
Yes, you might have to request this, and this is part of vetting the operator when you're looking at a particular deal, is if they refuse to share this with you because they say it's proprietary or whatnot, to me, that's a red flag. Another thing that I can ask for if they're a little reluctant to give me this original spreadsheet is to ask for one that is flattened, which basically doesn't have any formulas in it. So when you export it, you're going to export values only. and all of these formulas are hidden. And so you can see the numbers, but you're not going to be able to trace back any of those functions or formulas. And that would be the next best. And then the last one, sometimes they'll export it as a PDF, and it's very, very static, and you'll just look at it in a PDF format. But you just have to ask yourself, if they're unwilling to share this, what's the reason? And is there some format that they can share it with that you would feel comfortable, that they would also feel comfortable with? It really just depends on the operator. I've seen it all over the map, but most of them will share it with me. But I often do have to ask for it.
How would you grade this one? Like with the links, and if you had to grade this one, like, is this like an A+ spreadsheet with all these links? And I mean, this is like top of the line type thing.
Yeah, this is definitely above and beyond. I love the summary tab, the sensitivities tab. The waterfall is really easy to see. They've got helpful links on there. I think, like I said, there are a couple of errors on here. I don't know if it's because I broke it when I was working with it beforehand, but you might want to request an updated copy. And sometimes I'll do that because these things are very fluid. They're always getting new information and updating it. And so sometimes before I actually wire my cash over, I'll get the most recent copy and just make sure that it's similar to the one I originally looked at, just to be safe, because as they get new information, and they'll update this constantly.
Thank you very much.
All right. Great questions, everyone. And then we will see you next week when we review the PPM or the legal disclosures. That's going to be even more fun.
Thanks, Emma. Have a good night.
Have a good night, everybody. Thanks so much for coming.